We are covering the critical distinction between tax-qualified and non-tax-qualified long-term care policies for your health insurance licensing exam. The vast majority of policies sold today are tax-qualified, meaning they meet specific federal standards established by the Health Insurance Portability and Accountability Act, or HIPAA. For a policy to be tax-qualified, it must base its benefit triggers on strict criteria. The most common trigger is the inability to perform at least 2 out of the 6 activities of daily living, also known as ADLs, without substantial assistance for at least 90 days. The exam expects you to know these 6 ADLs: bathing, dressing, eating, transferring, toileting, and continence. The other primary trigger is suffering from a severe cognitive impairment like Alzheimer's or dementia. The reward for meeting these stringent federal rules is favorable tax treatment. The benefits received from a tax-qualified policy are generally not considered taxable income. Furthermore, the premiums paid may be partially deductible as a medical expense, but this is subject to age-based limits and only applies if the policyholder itemizes their deductions and their total medical costs exceed 7.5% of their adjusted gross income. Now let's contrast this with non-tax qualified policies. These are far less common and do not meet the federal HIPAA guidelines. Their main characteristic is flexibility. Because they aren't bound by federal standards, they can have more lenient benefit triggers. For instance, a non-qualified plan might pay benefits if a doctor deems it A.